Good afternoon, everyone. My name is Kateryna Davydova. I'm a broker with Compass and organizer of this event. I'm super happy to bring to you again Larry Pon. Some of you had already a pleasure of listening to his presentation last time when we had in January this year. And today is a new one on tax planning for real estate. And for those of you who don't know Larry, Larry has many credentials, and to name just a few, he's a certified public accountant, he's a personal financial specialist, he's accredited estate planner in Redwood Shores. I am excited and myself looking forward to this presentation. We have limited time, so let's get started. Larry, take it away.
Okay, thank you, Kateryna, and good afternoon, everybody, and welcome. Today, we're going to talk about tax planning with real estate, basically be a real estate case study. So what we're going to cover today is we're going to start with the facts, the fact pattern that we're going to use here. Then we're going to talk about the tax and financial planning consequences of a sale of real estate, tax and financial planning consequences of a 1031 exchange. Then we're going to go into the tax and financial planning consequences of taking advantage of a qualified opportunity zone. And then we'll close with tax and financial planning consequences of using a charitable remainder trust in conjunction with the sale of real estate. There's a lot of changes going on in real estate. There's a lot of pending legislation, so we'll make reference to that. But I'm going to be posting in the chat here a link to this handout so you can download a copy of the handout. So give me a second here. So let's see. So first, I'm going to give you the link to the handout. There we go. Okay, that's the link to the handout. All right, so real estate is a very tax-favored investment. It's one of the many asset classes out there when choosing to invest. It could be the home you live in, or it could be a rental property, or it could be raw land. But today, we're going to talk about a situation where this client has a rental property in San Francisco. So we're going to walk through this case study this afternoon. So we have an hour. So we're not going to be able to go into super detail of all the calculations and all the things here, but we can do another webinar on the tax consequences of buying real estate or owning real estate, or the tax consequences of selling real estate. So let's talk about this property here. It's located in San Francisco. They've had it since 1978, so they've had it for a while. The cost basis of this property is $223,000. And over the years, they've accumulated depreciation of $81,000, and it's paid off, so there's no mortgage on this property. Now, in terms of selling this property, it could be sold for $1,480,000. And currently, they're receiving rent of $44,000 a year. Is that market rent? Probably not, but that's most mom and pop landlords don't tend to charge enough for rent. So the current rent's $44,000 a year. And the expenses on this property normally is $11,000. So that's the insurance, property tax, and maintenance, and those costs. So costs might be high in some years where there's like repairs or seismic retrofit, those kind of things that you have to do when you have a rental property. So what do you do here? The tenants have just moved out. Should I keep renting out the property, or should I sell it? What should we do? So let's walk through this analysis here on this situation here. So according to Zillow, we go to Zillow, and the rental estimate according to Zillow is $4,600 a month. That probably sounds about right on what the market rent of this property should be. $4,600 a month. So that would be $55,200 annually. They were getting $44,000 a year, so they were probably below market. So the market rate's probably closer to $55,000 a year. That's $11,200 more rent per year. However, that tenant's been there for quite a long time. And so the property's going to need some fixing up, repairing, and getting ready to rent again. And to be able to get this higher amount of rent, they can't just turn around and rent it out. They probably need to update the bathrooms, the kitchens, get new carpets, new window coverings, and all those sorts of things. And it's probably about at least $150,000 to get this property up to speed to rent out. So do the math here. It's going to cost you 150 grand to get it ready to rent out again, and you're making an extra $11,000 a year. So the question is, does that make sense? Well, what if we just sell the property as is without any remodeling, whatever? And let's say we can sell it for $1,480,000. So let's say we do that. We sell it for $1,480,000, and that's net of costs. So let's just use that in our example. Net of costs, commissions, transfer tax, and fees, and all the closing costs you have to pay when you sell a property. So let's say we clear $1,480,000. And since they don't have a mortgage, that's the cash they walk away with, $1,480,000. Now, what's the tax bill if you sold this property? In this example here, the federal tax would have been $515,000. And part of that, yes, there's capital gains tax, there's recapture tax in there, which is at 25%. Capital gains is at 20%. It's a bit of complicated calculation. You can't just multiply and boom, there's the number, because this also includes $48,000 of net investment income tax. That's the 3.8% surcharge if your income's over $200,000 if you're single, $250,000 if you're married filing jointly. So the total tax here is $515,000, and there's no alternative minimum tax. So it's just the entire tax bill. Are we done? No, this property is located in California, so we got to pay the California tax. The California tax is about $150,000, and that includes almost $4,800 of what's called the mental health tax. So the mental health tax applies when your income's over $1 million. That's an extra 1% tax. So the total tax is about $665,000. So we sell this property for $1,480,000. We pay $665,000 in taxes. You'll walk away with $815,000. Some people might say, that's fine, I'll do that. But I don't know about you, $665,000 is a lot of money. That's a lot to pay there. So how about what's going to go on with the possible changes in the tax law? I'm going to later in the presentation, I'll post a link to a video I recorded on the American Families Plan. And that was presented by President Biden on Wednesday, April 28th, on his speech to the joint session of Congress and to us, the American Families Plan, which laid out a whole bunch of tax changes. And one of them is possible changes to the capital gains tax. Currently, the current law, capital gains rates are in 3 brackets. It's either 0%, 15%, or 20%. And of course, we'd love to be in the 0% bracket. And the 3.8% net investment income tax surcharge, that's when your income's over $200,000 if you're single, $250,000 if you're married. So that's the current tax rates. And if you have rental real estate, there's also the 25% recapture tax on depreciation. And that's been around for years, so that hasn't changed. So what's the proposal? The proposal is for taxpayers of incomes of over $1 million, the capital gains rate would be the same as ordinary taxes, which would be 39.6%. That's nearly double 20%, right? So that's in the plan right now. Also, no change to the surcharge, the 3.8% surcharge. That's not going to change. So this proposal is known as the Buffett rule. And this came from Warren Buffett because he noticed that his secretary was paying a higher tax rate than he was because most of his income comes from investments. So Warren Buffett was paying a lower tax rate than his secretary. So the politicians have taken that up and calls it the Buffett rule. So this is called the Buffett rule. So that's a possible change to the capital gains taxes. So that is prompting a lot of people, especially last year in 2020, to start taking capital gains or selling the real estate, paying the taxes now because 20% is a whole lot better than 39.6. So that's something to consider. It's not law yet. It's not there yet. It's got to go through Congress. Congress has got to get a bill passed, and then both houses of Congress, the House and the Senate, will have to have a bill for the president to sign before it becomes law. All right, so that's the sales scenario. So that's just taking the money and running. What about a 1031 exchange? So a 1031 exchange is when you take the proceeds of a sale of a business property, like a rental property or investment property, and roll that proceeds into another piece of real estate, another piece of rental real estate or investment property of equal or greater value. If you go lesser value, the difference will be what's called boot, and you'll pay tax on the boot. So what's the advantage of a 1031 exchange? Well, you defer the taxes, so the gain is deferred in the new property. So that's a major advantage of that. You avoid the 3.8% net investment income tax, so that doesn't apply. Of course, no alternative minimum tax. And most importantly, you take advantage of time value of money. And so that's going to be for that $665,000 as you would have paid in taxes, you're putting it to work into another piece of real estate. So that's where the beauty of the time value money comes into play. And this has been going on for quite a few years. So do we always need to do a 1031 exchange? Probably not. There's some cases where it would not make sense to do a 1031 exchange. So when do you want to take the gain? Just take the gain. Well, you need the cash. So if you need the cash, you don't do a 1031 exchange, because a 1031 exchange means the money has to be reinvested in another piece of real estate. You don't have the cash. Or you have loss carryovers or charitable contribution carry. You have carryovers that are expiring. So you want to take the gain to offset those carryovers. That might make some sense. You might have some capital loss carryovers, and that might be worth taking advantage of to absorb against the gain. Or you have a net operating loss carryover. There's a time limit to that. So that might make some sense. Or the gain's very small, or the proceeds are very small. If you're selling a $100,000 piece of property, it's probably not worth the cost and hassle to do a 1031 exchange. Or the tax bill is relatively small. It's a lot of work to do a 1031 exchange. There's a lot of people involved with it, a lot of legal paperwork and all that. If you're doing just to save $10,000 in taxes, that's probably not going to be worth it. So there's some cases where we don't do a 1031 exchange. So what does this mean? The property must be like kind. It's got to be real estate. It's got to be business use or investment property. So what that means is it can't be a house you're going to live in. It can't be your principal residence, because that's not like kind. So it's got to be a like kind property. So here's some creative tax planning we can do here. What about my home, my personal residence? Can I do a 1031 exchange with your home? Yes, you can, but you got to do some tax planning. First, you got to convert your home to a rental property. You got to do that. And we're going to go over an example of a scenario where we do that. So yes, you can, but it's going to take some planning. And you got to watch the timing rules too. You can't rent it out for more than 3 years, because if it's rented out for more than 3 years, you're going to lose what's called the 121 exclusion. That's the $250,000 per person exclusion on a sale of a principal residence. For a married couple, that's $500,000. So if we recognize boot, we only pay taxes if the boot's more than the 121 exclusions. For example, if you're a married couple and your boot is $400,000, well, that's less than $500,000, and there's no tax due. But let's say your boot is, let's say $800,000. So 800 minus 500 is $300,000. Then $300,000 would be taxable. So boots only recognize if it's more than that. So the way it works is, and we'll show an example. We take the 121 exclusion first, compute if there's any boot, figure out what the 1031 gain is, and then that gets deferred into the new property. So the basis includes the residence deferred gain. So we'll go over an example of that. All right, so types of properties. So what happened with 1031 exchanges is, since the 2017 Tax Exempt Jobs Act, it only applies to real estate, no longer personal property. So during the 2017 tax law debate, they were going to get rid of 1031 exchanges for everything. So the real estate lobby was able to keep it for real estate. So it could be any type of real estate, improved real estate or unimproved real estate. It could be raw land, residential or non-residential. Leasehold interest can qualify. It's a little more complicated, but it can qualify. And fractional interests. qualify. So for example, you don't have to be 100% owner of the new property. You could be a partial owner. You can own of other people. And we're going to talk about that next. So what used to be very common was doing a 1031 exchange into a property owned via a tenants in common, a TIC. That was pretty common, probably in the early 2000s, then 99 or so, because the IRS blessed this type of transaction. Basically, a TIC would mean there's no more than 35 co-owners. The co-owner will have to hold the title directly. So when you look at the deed, there's each person's name there. They can't use a common name. So for example, it can't be 123 Main Street or something like that. So it's not a legal entity. And the decisions are unanimous. It has to be unanimous. So there's been some challenges, right? How do you get more than a few people to decide to do things at the same time? There's no one in charge. So that's one of the downsides of the TIC. And all the costs and revenues are shared on a pro rata basis. So if you're a 30% owner, all the costs and revenues are shared 30%. A little different than a partnership. But this was a common way to go, was a TIC. We don't see those marketed too often anymore. There aren't too many of those out there anymore because of these complications. What's replaced the TICs are what's called Delaware Statutory Trusts, or known as DSTs. It doesn't have to be in Delaware, but it's just the state of Delaware has put this statute together to make it very easy to package real estate. And it's usually investment grade real estate. So it could be a shopping center, a office building, or something like that. Investment grade properties, not a duplex or something like that. So it's an alternative to TICs. The IRS has blessed this structure. So we're seeing these more and more. And now that there's more activities, there's more expertise, it's gotten a lot better. And I feel a lot more comfortable recommending them now. In the beginning, when they were first authorized and all that, I really wasn't too comfortable with them because I wasn't sure the people who were getting into this business. But these are what's called business trusts. There's someone in charge. And so the trust holds the property. So the deed will have the name of the trust and it guarantees the mortgage. So this means that you'll get a better loan because it'll be an investment grade property with a better mortgage versus a TIC. A TIC means if there's 10 of you, all 10 of you have to fill out the application, So that's how that works here. Okay, so it's easier to get financing, they're investment grade properties, and the units are smaller. So you can, depending on which provider you go through, some are as small as $10,000. So it gives you a better chance of diversifying by types of property. Let's say it could be a residential rental, like an apartment complex, or a shopping center, or an office building, or a warehouse. You can diversify types of properties. But watch out for the costs and make sure you study the managers and make sure they have experience doing this and they have a good track record. So that's what that's all about here. So for 1031 exchanges, some timing rules to consider. 45 days, you have 45 days to identify the property just relinquished. So watch out for that timing rule. Normally what happens is you work with an accommodator, a 1031 accommodator. When you're going to do this, you tell the title company that I'm doing a 1031 exchange and you pay a nominal fee for that. And they're going to shepherd this through. Make sure you fill out all the paperwork to meet the legal requirements. Now, when you're identifying properties, don't get carried away. It gets more complicated if you identify too many properties, that can get you into trouble. So no more than 3 properties. Use a qualified intermediary. There's many companies that specialize in doing this. Many title companies own a company that does this. So they hold the funds. You can't touch the money because if you touch the money, it's going to be taxable. So they hold the funds, so you can't touch them. They have agreements to limit access to the money. And no, it can't be your agent, it can't be your relative, and it can't be your CPA. So there are many cases where people have done that. All right. So what is boot? So boot is when you do a 1031 exchange and you take cash out of the transaction. You sell property for $1 million. Your new property is $900,000. So you took $100,000. Well, that's going to be taxable. So when you have boot's taxable, or you have what's called unlike property. So in some cases, when you buy a house, some sellers are giving a car. Well, a car is personal property. So if you get a house and a car, well, the car is unlike property. So I've seen that. I've seen some articles in Florida where not only do you get a car, you get a boat. And in some cases, you don't, not just a boat, you get an airplane. Well, that's personal property. So you got to watch out for that. Also, relief of debt. So you gotta be real careful when you're trying to get really creative with loans when you're doing these kind of exchanges. So if liabilities being transferred versus what's assumed, if you're taking on more debt, that could cause boots. So you gotta be careful about that. All right, so let's talk about the sale of a principal residence here. And I can see in the chat here, the question from Jamie is, how many times can you take the 121 gain exclusion? 3 years, I think, isn't it? I think it's every 3 years. To qualify, the home's got to be your principal residence 2 out of the last 5 years. 2 out of the last 5 years. But don't quote me on this. I think you can't do it every year. I know that. You can't do it every year. I think it's every 3 years, I think. We'll have to get back to that one. But if you want to do a 1031 exchange with your home, because let's say you have a large gain on your home, you want to shelter some of that gain. Well, you have to convert your principal residence to a rental property. And that might be a challenge. It might not be that hard. I don't know. It's up to the property situation. So you convert your home to a rental property, sell within 3 years, then you still get to take advantage of the 121 exclusion, the $500,000 if you're married, 250 if you're single. So if you occupy and own it for 2 of the last 5 years, oh, here we go. No sale of principal residence in the last 2 years. So there we go. That's the answer to the question that Jamie had. How many times can you take the 121 gain exclusion? Every 2 years. 2 years. It's right here on my slide. So let's take an example here. Let's use this example here. So let's say we have a house that's worth $2 million and the cost basis is $500,000. So if we sold this house, the gain is going to be $1 million. That's 2 million minus 500. That's 1,000,005 minus 500 equals 1 million. So if I just sold the house, my gain on this house is $1 million. Well, let's say we convert this house to a rental for less than 3 years. Now, don't be cute and rent it out for a day. That won't count. So have a lease, have a legitimate rental, not a month-to-month lease or a day-to-day lease, but a real lease. Probably at least 6 months. There's a lot of court cases on this fact pattern here, and I'm sure we're going to see more. The most interesting thing is if you read the court cases on this issue, for some reason they're all located in the Bay Area. I don't know why, but there's a lot of San Francisco, San Mateo, and Atherton court cases on these type of issues. So maybe we take advantage of this a lot around here. So let's say we rent this house for less than 2 years, and then we sell this home for $2 million, let's say, $2 million when it's converted to a rental. And you want to downsize. You didn't want to buy a new house for more than 2 million, so you buy a new house for $1.5 million. So 2 million minus 1.5 million is 500,000. That would be normally boot, right? Well, the 121 exclusion applies to that $500,000. So you get to pocket this $500,000 tax-free. Pretty good deal. The $500,000 is tax-free. So you do the 1031 to another property, but the new property will have to be a rental property. So you can eventually move into the new home within 2 years and keep the same property assessment from the original property. So that's been kind of modified by Prop 19, but that's the thing here. So if you have a low assessed value, you can still transfer that with the changes of Prop 19. All right, so here's continue on the example here. So first we apply the sale of home rules before the like-kind exchange. So 121 goes before 1031. So the 120 exclusion must be applied to the gain from the exchange before the application of 1031. Now, if you have depreciation recapture, which you will, because when you rent out a property, you have to claim depreciation. You can't say, no, I want to ignore it. No, it's by the tax law says you have to claim depreciation. So that is required. And the boot would be taxable if it's more than the 121 exclusion, more than $500,000, let's say. So the basis in the new property is what you paid for the new house, less the deferred gain. So I think I'm blocking some of the words here. I'm sorry. So basis in replacement business property is increased by any gain attributable to the relinquished property that is excluded under 121. All right, so that's the basis of the new property. So here's an example here. So let's say we have a house that costs $210,000. We rent it out for 2 years and we claim depreciation deduction of $12,000. We exchange it for a new house for $470,000. And actually, no, the existing home is worth $470,000. And you exchange it for a townhouse for $460,000. See, you keep the $10,000 cash, and the townhouse is rented out to tenants. So the gain realized is $272,000. The amount realized is $470,000. You sell it for $470,000. So the basis is 210 minus 12 equals $198,000. So the realized gain is 272, but the gain is excluded under 121. That this is a single person, so $250,000. So the gain to be deferred under 1031 is $22,000, which is the 272 minus $250,000 equals $22,000. Since the gain is less than $250,000, the $10,000 of boot is less than $250,000. There's no tax here. So in this example, you get to pocket the $10,000. Okay. Now we got to watch out for some little details here. So we can't take advantage of the 120 exclusion for properties that's been exchanged in the last 5 years. So you got to take a look out for that. This is a relatively recent rule that the IRS has added. So it's going to take some real careful tax planning if you want to take advantage of this. But you can save a lot of money in taxes. We just got to be careful on the tax planning. All right, so back to our case study on the 1031 exchange. So what's your choices? You can, it was a single family home in San Francisco. You can buy another single family home, pros and cons with that. Or we can take advantage of what's called a triple net lease commercial property. That's like a single property. That's a very common thing to do. Or you get multiple properties through the DSTs for more diversification. You exchange it for that. So those are some of the choices we have. So in this example here, what did these people do? They end up buying a property in Texas because the numbers in California don't work out so well for rental properties. So it happened to be in Texas, and it happened to be at Del Taco. They're a university. Boy, they sell a lot of tacos. And in the pandemic, they were concerned that they weren't going to get the rent. They've doubled the revenue. Why? They've got a drive-through. The cars just flowing through the drive-through. So, they sold a lot of tacos. They're paying the rent. So they bought this property for $1.5 million. It's got a 10-year lease on it, 5% increases every 5 years with options to renew for additional 10 years. So that could be a 20-year lease on this property. And the rent is $93,000 a year. Remember, they were getting $44,000 on the single family home. They're getting $93,000. This is a triple net lease, which means they get $93,000. The tenant pays the property tax, the insurance, the maintenance, and upkeep. So they're just getting $93,000, a significant increase of what they're getting. The cap rate on this is 6.2%. So that means the cap rate is the 6.2% times the value of the property. That's the rent they're getting. So they're getting an extra $60,000. Since it's a triple net lease, it doesn't qualify for the qualified business income deduction. So we don't really care about the original basis calculation for that example. So that this is a pretty good thing to consider. Increase your income. So if we're going to do a 1031, there's a whole bunch of forms we got to consider. Form 8824, which is the 1031 exchange form. Form 4797, which calculates the gain. Schedule D, the capital gains form. And if you're in California and you're exchanging to a property outside of California, there's a new form called Form 3840. California is one of those states that's called a clawback state. There's a half a dozen states that are clawback states. What that means is if I sell a property do an exchange, defer the taxes, but goes out of state, if that property already gets sold or there's a gain, that state will recover the taxes. So California, if you ever have a gain on your replacement property, California will get their taxes. And you have to file the 3840 every year. If you don't, it's going to be immediately taxable. So that's not going to be a whole lot of fun here. That's a new form. So what can happen? Well, in the American Families Plan that President Biden is introducing, that there's going to be some changes to 1031 exchanges. It was almost eliminated back in 2017 when they were negotiating the Tax Cut Jobs Act. During the campaign, President Biden said, let's get rid of capital gains loopholes for multimillionaires. And this is one of them. So what the proposal says that if your income is over $400,000, you can't use 1031 exchanges. However, there's another version of this. There's more than one version of the possible change. Another version is that if your gain is more than $500,000, you cannot do a 1031 exchange. So if the gain's less than 500, you can't. So that's another version of this possible change. So we'll stay tuned to see what happens with the pending legislation. All right. So that's 1031s. Let's take a little break here and look at the questions here. So Linda's got a question here. Can you do a 1031 exchange with your primary residence if you only rent out a room? If yes, can you still claim the capital gain exemption? And that's a very good question, Linda, because there's a lot of court cases on this and a lot of IRS guidance on that issue. So a common scenario is, instead of just renting out a room, a common scenario we see quite often is I have a 2-story building, let's say. We have a 2-story building, ground floor is rented out to a restaurant. So it's a rental property downstairs, but I live upstairs. So it's a 2-story building. That's very common in many places. And so the answer is yes, you can do a 1031 exchange for the business portion, which would be the restaurant you rent out downstairs, and then the sale of the primary residence could apply upstairs. So something like that. Now, when it comes to renting out a room or something like that, you have to take the percentages. So some careful math has got to be done. But if you're just renting out a room, the numbers aren't going to be very significant. So it might not be worth it, but it's worth considering, worth thinking about. All right, let's talk about qualified opportunity zones. This is brought on by the 2017 Tax Cut Jobs Act. This is new. And the Biden administration is all for this. They're expanding this. They are firm believers in qualified opportunity zones. So we're going to expect to see more of this. And currently, the qualified opportunity zones are based on 22 census. So it's based on 2010 census. So you can go to your search engine, type in qualified opportunity zone, and there's a map of where you can find where they're located. But what it does is it gives you an opportunity to defer or all or portion of your gain. You get a permanent exclusion of some gain held for at least 5 years, permanent exclusion of all the gain if you hold it for at least 10 years. But just like a 1031 exchange, you've got a time limit, 180 days of sale to roll the gain in this property. And then the gain on the qualified opportunity zone property is recognized an early year of when you actually sell that QOZ property, or December 31st of 2026. So that's when you have to pay the tax on that. So if I take the gain and roll into a qualified opportunity zone property, the basis starts at 0. And then you add the gain recognized on the 2026 return. So in 2026, when you pay the taxes on it. Now, if you hold it for 5 years, you get a 10% increase of the basis. If you hold it for another 7 years, you get a 5% increase. And after 10 years, if you hold it for 10 years, the basis is the fair market value. So there's no gain, no taxes after 10 years. So you have to hold this for at least 10 years. However, to get the full benefit, the extra 5%, that only applies if you invest by December 31st of 2019. So starting now and in 2020, you don't get the extra 5% increase in basis. It's just the 10%. And that's the way the rules are written. Is that going to change? We'll see. We'll see if that's going to change. So let's see if we can use the QOZ in our example here. In our example, it doesn't make sense. So we have $1,480,000 as the sales price. So gain is 1,257,000. So if we want to take complete advantage of this qualified opportunity zone, we got to reinvest 1,257,000 into a qualified opportunity zone. Now, California didn't adopt it, so you still got to pay the California tax on this. So that's about 150K. The recapture tax is not sheltered by the QOZ. That's about 20 grand. So you still have to pay about $170,000 in taxes, even though you're taking advantage of the qualified opportunity zone. Better than the 665,000, but still. So of the money you're taking out, you still got to pay the California tax and the recapture tax. Now, I use 2019 here to show you the full impact of it. The full impact of qualified opportunity zone. So to fully qualify, we did this back in 2019. So we go to our time machine here. We did it in 2019. So 5 years from 2019 is 2024. So we get a 10% step up in basis. 1,257,000 times 10%, it goes up 125,700. Now, under the current situation, that's all we get. In 2026, you get an additional 5% step up. So the basis is then $188,000. But to get the full amount, you got to invest by 12/31/18. So you can ignore the 2026 line here because that doesn't apply anymore. And then in 2026, you'll have to pay the tax on the deferred gain. And then in this example here, for 10 years, so if you hold it for at least 10 years in 2029, the basis is equal to the fair market value at that point. So if this property is worth $2 million and you sell it for $2 million, so 2 million minus 2 equals 0. So if you have to hold it for 10 years to completely avoid the tax. However, in 2026, the tax has been deferred. So on April 15th to 27th, you're still going to have to pay the $495,000, assuming no change in tax law. So what's the tax law going to be in 26? Don't know. Might be higher, right? Might be double this amount. Something to be aware of. So what do we do here? We get $1,480,000, got to pay the tax on the sale, and then do we set aside the money for the taxes are going to be due in 2026? I put in a CD or set aside, or hopefully we'll have it when April 15th to 27 comes along. So the next cash is $815,000 in this example here. So you have to invest the whole $1,257,000 to take full advantage of this. So you're still going to need $442,000 to pay the tax bill. So, frankly, in this example here, it doesn't look like that good of a thing to do in this case. When does QOZ make sense? It makes sense when the gain is smaller. So let's say I sell something for $2 million, the gain is $100,000. Yeah, I could defer the whole $100,000 to QOZ, and it won't be as drastic as this. So let's compare and contrast QOZ versus 1031. For qualified opportunity zone, most capital gains qualify. So it could be sale of stock, sale of cryptocurrency, real estate. It doesn't have to be just real estate. It could be any capital gain. It could be short-term or long-term. With qualified opportunity zone, you just reinvest the gain only, not the principal amount like a 1031 exchange. And there is no identification period for a QOZ. Location with the 1031, you can be anywhere except for outside the U.S. It has to be within the U.S. For QOZ, it's got to be in a specific qualified opportunity zone. The way the law is written right now, 1031 is available. QOZs are due to expire on December 31st of 26. So we'll see what happens. That might get extended under the current administration. Now, for estate planning purposes, the QOZ is not subject to a step up in basis. So if you pass away, you don't get a step up with the qualified opportunity zone property. However, at 1031, there is a step up in basis here. So it doesn't look like a great deal in this case here, but we can take a look at other situations, see if it makes sense. Also, just like Delaware statutory trusts, it's usually the same people who do these types of properties. Got to do some research, read the prospectus, do some research on the property you're looking at. Who are the operators? Do they have experience? What are the costs? And you got to do your research on it. Don't focus on just the tax savings. Guys, make sure it makes sense. All right, we're running out of time here. So we're closing with talk about using a charitable remainder trust as a way of sheltering some of the gain from the sale of property. It doesn't have to be rental property. It could be your home. It could be rental. Could be your principal residence. We have a lot of people here who bought their homes many years ago. Now it's appreciated a lot in value. But one thing to consider is taking advantage of charitable remainder trusts. And we've done this for our clients in the past. A charitable remainder trust could be a great way of providing some retirement income. And that can work out pretty well. It just works if you have charitable intent. If you have no charitable intent at all, if you're only wanting the tax break, well, you're going to be not completely satisfied. So charitable intent is very important. You get a charitable deduction when you're doing this, and we can structure so you get income for the rest of your life. Now, if you're young, it might not work out for the rest of your life, but we can set up for a 20-year charitable trust where you get the payments for a trust for 20 years. Now, the remainder at the end of those 20 years or when you pass away, it goes to a charity. It goes to a charity, not your family, your charity. I know. People keep saying my family is my charity. All right. So in our example here, let's say we put half the property into a charitable trust. You keep half the property, you transfer the other half. And let's say you're 70 years old. The IRS says the minimum payout rate of the trust is 5%. That's the minimum. You can certainly go higher than that. Now, the higher you go, the lower the tax deduction. So the lower you go, the higher the tax deduction. So you kind of do the math to see which works out here. So in our example here, we're going to use the 6.2% to match the triple net lease rate on the exchange property, just to make the math a little bit easier. Instead of naming a charity directly, you can name your donor advice fund to be the charitable remainder. In terms of the type of trust, this could be another whole webinar in itself. There's many kinds of charitable trusts: a charitable remainder Unitrust versus a charitable remainder annuity trust, CRUT versus a CRET. You probably most likely recommend a CRUT. So here's an example here. So let's say we put a $740,000 property into a trust. And it's a 5% Unitrust. So 5% of $740,000, $37,000 of income. And upon your death, the charity will get whatever's left in trust. It might be $203,000 or so. So that can work out. That's using 5%. Now, if we did 6.2%, you get a little more income, but less goes to charity. And I'm not going to go into detail here on how to calculate how this is the table we use to figure out what the tax deduction is going to be. But and this just kind of summarizes what was in that table there. So 5% times $740,000 is $37,000 a year coming from the trust. Nice supplemental income. And it's just coming from the trust. It's not rental property or a note payment, whatever. It's just coming from the trust. By contributing to $740,000 property at age 70, you get a $303,000 tax deduction, which would be used to offset the gain from the sale of the property. So if we did this, instead of owing $665,000, you owe $170,000. So by putting half the property into a charitable trust, you save over $500,000 in taxes. So something certainly worth considering. And then you get income of $37,000 for the rest of your life. So something to consider. And the other half of the house, you get to take advantage of the $500,000 exclusion if it's your principal residence, and you can do whatever you want with the money. So a charitable remainder trust could work out pretty well. This slide, I just changed the math to the 6.2%. So if it's 6.2%, that's about $46,000 of income. Now, if the unit trust, what that means is the payout is going to be based upon the value of the trust at the end of the year. So if it's invested so it grows in value, your payout will grow. So that helps protect you from inflation. So this works really well if you're charitably inclined. So we save a lot of money in taxes. We get a tax deduction, and you will eventually benefit charity in the future, and you get a source of income for the rest of your life. So something to consider. So charitable trust is a great tool that's worth using. So something I wouldn't discount here. All right. I know we went over that really quickly here, but I just want to introduce the concept. So let's talk about other taxes to consider and other tax considerations here. So I'm going to post in the chat here a, a link to a video on the American Families Plan. So I'll put that in here. And that was just recorded this week after President Biden gave his speech to the joint session of Congress and to us on Wednesday, April 28th, the American Families Plan. Well, there's a lot going on in the tax world. So there's a bill sponsored by Senator Bernie Sanders and Sheldon Whitehouse. So we've heard of those two guys. The bill's called the 99.5% Act. Now, this is nothing new. We've seen this before. It was introduced in 2019. The title was the 99.8% Act. So now it's 99.5% Act. So what does that do? Some substantial changes to taxes. So number one is the gift, estate, and GST exemptions can be reduced from the current level of $11,700,000 to $3.5 million, which is the 2009 exemption level. It's probably going to be inflated for inflation. So they're going to use 3.5 million inflated to inflation, might be closer to 4 million or so, maybe even 5 million. We'll see. The gift exemption is $1 million, but not indexed for inflation. So it's just $1 million. And the current estate tax rate is 40%. Now it's going to increase 45% if you have 3.5 million to 10 million, 50% from 10 to 50 million, 55% from 50 million to $1 billion. And this is what Kateryna is going to pay when she passes away. 65% if you're over $1 billion, right? 65% if you're over $1 billion. So that's in the 99.5% Act. Now, right now we have a $15,000 per donee exclusion, which you can give to as many people as you want. If I have 10 grandkids, I can give each grandkid $15,000 without any gift tax consequence. Under the Bernie Sanders bill, only 2 gifts. So if you give more than 2 gifts, they would be what's called a taxable gift, which will apply against your lifetime exemption. All right, we're not done here. Senator Chris Van Hollen of Maryland has introduced his bill. The acronym is STEP, S-T-E-P, and I talk about it in this video I linked to here. Now, what that bill does is going to impose a capital gain tax on death. So basically, if you want to see how this law works, go to Canada. Canada has this law. So this is basically, he just cut and pasted the Canadian tax law and plunked it here. So basically, when you, it's not just on death, it's on any transfer. But the bill says that he gives you $1 million exemption. So the first $1 million is tax-free. Anything over $1 million is going to be subject to capital gains, and it could be at 39.6% plus the 3.8% surcharge. So that's the STEP Act, STEP. Senator Ron Wyden is the chair of the Senate Finance Committee, and that's the committee that writes our tax laws. So he put out a bill that, this is France here, France. So France has something called a wealth tax. And so he's copying France here, and he wants to impose a tax on any increase in value of assets from year to year. It's kind of known as a market to market tax. So right now, some of us might be sitting in a house that we paid $100,000 for. Now it's worth $1 million. You don't pay any tax until you sell the house. Or I bought some stock for $1,000. Now it's worth $10,000. So it's gone up in value, and you're going to pay tax on it. California has also introduced their version of this wealth tax. We'll see what happens with this, just to let you be aware of what could be happening. Now, back in January, Kateryna and I did a webinar on Prop 19, and I'm going to put that in the chat here. The link to that webinar we did back in January, and many of you were there. So here's a recording of that I put in the chat here. And so There's been some significant changes in the California property tax rules. The good part is makes it easier to transfer your assessed value. However, the challenge is going to be when the property gets inherited. So there's been some changes to Prop 19, and this is from our last webinar we talked about. So what other possible changes are there in tax legislation? A lot. And they affect specifically real estate. So for example, if you have rental real estate and you have losses on the rental real estate, you can take up to $25,000 a year of losses on your rental real estate if your income is below $150,000. And this law has been with us since the 1986 Tax Reform Act. That might go away. Possible elimination of the qualified business income tax deduction. Now, in the American Families Plan, it's a little bit modified. It looks like it's going to be curtailed if your income's over $400,000. So for many people who have rental real estate, this is a significant deduction. This is a 20% deduction against your qualified business income. So just think if you made $100,000 of qualified business income, that's a $20,000 deduction. So that might be eliminated. We currently have what's called bonus depreciation. You buy equipment for your business, you make improvements to your property, whatever. There's what's called bonus depreciation. And we've had these for the last few years. That might be eliminated. We'll see, because the equipment lobby, they want to encourage investments. How about itemized deductions, the mortgage deduction limitations? So right now, the deduction on a home mortgage, if you're buying a home today, the deductible limit is $750,000. Now, if you got the mortgage before December 15th of 2017, you're grandfathered under the old law with the $1 million limitation. So you got to be careful about that to maintain that limitation if you got your mortgage before 12/15/17. SALT deduction limitations. Right now, for your state and local taxes, your state income taxes, your property taxes, many of us pay more than $10,000 in property taxes. The deduction limit's $10,000. Well, over 20 Democratic Congress members have said that they're not going to vote on any of these bills unless this repeal is part of the law. So we'll see what happens with that. Also, the itemized deductions might be limited, meaning the P's limitation might be reinstated. That might come back. That means if your income's over a certain amount, and I think that number is going to be $400,000, a portion of your deductions will be reduced. Also, the value reduction might be limited to 28%. So if you're in a 39% bracket, instead of getting a 39% tax benefit for your mortgage deduction, it could be limited to 28%. So there's some planning considerations we need to think about on what that means. So let's take a little break here, and let's take a look at the chat. Is there anything in the Q&A? I have not seen the Q&A. Okay, I'm going to take a little break here and take a look at the Q&A here. Let's see. Gene says, for a primary house I'm in to rent less than 3 years, then sell it. Can I exchange it with keeping $250K? Okay, yes. So Gene, we went over that example. You can watch the recording of this video where we took advantage of the 121 exclusion. That's $250,000 exclusion and a 1031. So you have to convert your home to a rental. Yes, you had to live somewhere else. So you have to convert it to a rental. So those are those questions here. Let's take a look at the chat here. Okay, please resend the link to the handouts. Okay, let's try that. Let's do that. Okay, I'm going to post the link here. Here's the link to the handouts. So it's a copy of the slides that you're seeing here. Okay, so that's in the chat. Okay, great. All right, so it's okay. You see anything, Kateryna?
There is a question from Pamela. How soon could you move into a 1031 exchange to make it personal residence? Repercussion?
Yeah, that's a very good question, Pamela. There's a lot of court cases on that. So it's fact and circumstances. So there is no direct answer from the IRS. They don't say a certain number of days or a certain number of months. So it's based on the fact and circumstances. But there's a lot of court cases on that. So we can use some common sense here. So, for example, if I exchange my property for another property and I rent it out for a day and I move into it the next day, that obviously doesn't sound like it makes sense, right? So, use some common sense that yes, it's a rental property, and to bolster the fact that it's a rental property, you have a lease with the tenant. You hire a property manager. Now, there are some cases where the property was never rented out, but the owners did their best. They put out flyers all over town, but because of the market conditions, they couldn't get it rented out or whatever. So it's based on your facts and circumstances. You do your best efforts to make it a rental property. All right. So anyway, I got a message here that we're having some trouble of links. Okay, is it the link to the handout, because it should be it should be available, or maybe I hit the wrong button. Sorry about that. Give me a okay. Let me get the link.
I think what is happening when we click on your link, then it takes us to Google Drive, and you have to give us the permission to view the slide.
Okay, well this should work. So if it works, give us a thumbs up. All right, give us a thumbs up. So that works. Okay. All right. Great. This is good. We're at the top of the hour now. So let's close with our conclusion here. So I talked these clients out of paying $665,000. That's a lot of money to pay to the government. So they did do the 1031 exchange. They are getting the additional rental income, and it worked out pretty well. They're still getting their rent. They're making more money. Now they're complaining about paying more taxes. Well, go figure. But anyway, you're making more money. So, but the thing is, when it comes to dealing with real estate, it could be your home, could be a rental property, investment property, a lot of options out there. But what makes sense is working with experts like us to evaluate what makes sense for you. What are the consequences? We can't tell you what to do. We're not going to tell you what to do, but at least we can help you figure out the consequences if I did it this way versus that way. What we don't like to see is, you've done something, now what? So, it's like, it's always good to engage us before you sell the property or before you make a major decision, because we can see things that can save you a lot of money. So anyway, let's see, I'm reading the chat here. Let's see. And okay, I think we're good here. So Kateryna, do you have any closing comments you want to make?
If you have, did you help them evaluate the market in Texas too?
What we did was we had a real estate broker take a look at what's available to them, and what he did was he took a look at multiple properties and did some analysis and try to, there's some screens you look at on properties, right? And if I always highly recommend, I mean, I didn't go, but I highly recommend that you go visit the property that you're going to buy, especially if it's going to be over $1 million, right? In one example, this was a different transaction. Client went to visit one of the properties. He had 3 choices. The realtor gave him 3 choices. So I said, take a trip. It's tax deductible. And he went to visit the properties, took a look at the area. I guess you don't learn that much through the internet or whatever. So the first one he went to, he happened to walk into the Chamber of Commerce office, and he said, hello, how's it going? He goes, you know what? The 3rd time we've been robbed. I said, oh, okay. And so didn't pick that property. The second one was there's a lot of plywood everywhere. All the properties were boarded up, and he drove for miles and miles to find this property. And in the surrounding area, everything was abandoned. It looked like a nuclear bomb hit the place. So that was not a good idea. So the one he did pick up is in a up and coming area. It's one of the areas that are really growing. A lot of people, because of the work from home situation, are moving to this location. Happens to be in Kansas. Kansas is enjoying a boom. So it happens to be in Kansas, and he's collecting his rents, and it's working out well. So you got to do your analysis of the properties and all that. No, I'm not a real estate expert per se. That's why we work with real estate experts, but well, we understand business and taxes. I'm not a lawyer either. So we always recommend getting a real estate lawyer involved to review the lease, because sometimes there could be some stuff buried in the lease that might not be the most favorable to you. So it's always good to rely upon experts objectively, because we're not emotionally involved in the transaction. All right. So one last question, and we're going to turn off the recording. Okay. You mentioned recapture must be paid at the time the QOZ investment, but does recapture get deferred if a 1031 exchange is executed? That's correct. That is one difference between a qualified opportunity zone and a 1031 exchange. A 1031 exchange, all the gains deferred to the new property. With the qualified opportunity zone, not all the gain. It's just the capital gain. So not the recapture tax, because that's not considered to be a capital gain. So that's why that is taxable. So we got to take a look at the numbers and figure out what the bill is going to be. So I'm going to shut off the recording now, and thank you for your attention today. Boy, that hour went pretty quick. I hope this was very helpful, but let Kateryna know if there's other topics you'd like us to cover. I love talking about taxes. I can talk about taxes all day long. So thank you for your time, and thank you for your attention. I look forward to speaking to you guys again. Thank you very much, and have a great day.
Thank you so much, Larry. And again, if you are interested in any future topics, please send us a quick email and we'll do our best to put a good webinar together. And I have a quick announcement before I let anybody go. There will be another webinar on trusts. If you are interested in this topic, it will be next Saturday, May 8th from 2 to 3 p.m.
Hey, who's your speaker?
And the speaker is Brett Lytle. He is an attorney at law with the law offices of Brett Lytle. So
yes.
It was an interesting topic.
And I highly recommend Brett. Brett is a good friend of mine. So he gets an endorsement. Very good.
All right. Thank you everyone for attending.
Thank you.
Kathy.
All right. I'm going to turn off the recording now.